All right, today we're cracking open the Indianapolis Industrial Market. We're using a strategic guide from expert Cara Conde to figure out why this Midwest hub might just be one of the smartest places to invest over the next few years. So let's dive in and see what's really going on.
It kind of sounds like a trick question, doesn't it? But that's the puzzle we're piecing together today. I mean, high vacancy rates usually scream danger, stay away. But in Indianapolis right now, they might actually be a flashing sign for a rare and very brief investment opportunity.
And this is exactly why we should be paying attention. According to the source, what happens in Indianapolis, well, it doesn't stay in Indianapolis. It's a preview of what's coming for the entire Midwest supply chain. So if you can understand this market, you don't just get insight, you get a real strategic edge.
Okay, so let's get right into this really counterintuitive situation. We're calling it the Indianapolis paradox because on the surface, things look one way, but when you dig into the data, it tells a completely different story.
This slide lays it out perfectly. The surface story is pretty simple, right? A building boom in 2024 left a lot of empty space, and that looks like a classic downturn. But the deeper story, the one for investors who are really paying attention, is that this glut of supply has created a temporary buyer's market. The thing is that leverage is about to flip, and the window to make a move is a lot smaller than you think.
So what's at the heart of this paradox? It's a market that's rebalancing itself at lightning speed. You've got this huge supply of new buildings that's about to collide with a sharp drop-off in new construction and really steady demand.
And here is the key number that tells us the party is almost over for buyers. A drop to 8.5% vacancy by the end of 2026. That tells us that companies are expected to be leasing space faster than new buildings can be finished. That surplus of space, it's about to get soaked up and fast.
And this chart shows you exactly why that market is going to tighten. You know, high interest rates and capital costs have just slammed the brakes on new projects. As you can see here, new construction is projected to fall off a cliff, hitting a 5-year low. And when fewer new buildings are coming online, the ones that already exist just become that much more valuable.
This table really brings it all home. Just look at that strategic impact column. Cap rates, they're stable for now, but are expected to compress, which means prices are gonna go up. Rents, they're projected to grow, which is a fantastic hedge against inflation. And vacancy, we know that's tightening. Every single one of these key metrics is pointing to the exact same conclusion. The time to buy is now.
Let's just zero in on that 7.3% cap rate for a second. Think of it as a measure of your return on investment. For buyers, that number is magic right now. It represents a way better return than the super low rates we saw back in 2021 and 2022, and it creates this perfect entry point before the market fully shifts back to sellers.
But here's the twist. It's not just about buying any warehouse. The very definition of what makes an industrial building valuable is changing, big time. The next wave of value is all about technology, power, and automation.
So you might want to get used to a new term. Megawatts per square foot. Seriously, this is becoming just as critical as location. Modern industrial users, we're talking everything from advanced manufacturing to data centers, they need an incredible amount of power. A building's value is now directly tied to how much juice it can handle.
So, what does a future-proof building actually look like? Well, it boils down to 3 simple rules. First, that massive power capacity we just talked about. Second, you need clear heights of 40 feet or more to handle all the vertical automation. And third, you need super heavy-duty floors that can support the next generation of robotics.
And this is where things get really serious for older buildings. If a warehouse can't support the power and automation that modern logistics requires, it risks becoming obsolete. It could become a stranded asset, basically a property that's tough to lease and just loses its value over time.
Okay, so now we know what to look for in a building. The next question is, where do you look? The expert guide actually lays out a very specific geographic playbook for the Indianapolis market.
And the strategy breaks down into 3 completely different plays. First, there's the institutional core out in West Hendricks County. That's for your stable, predictable returns. Second, you have the value-add play in the East, which is all about buying up discounted big buildings to cash in on future demand. And third, you've got the high-demand niche in the northern suburbs, focusing on those smaller flex spaces that are in super short supply. So, 3 different strategies for 3 different kinds of investors.
When you put all of this together, it leads to one crystal clear message. This unique moment, these buyer-friendly conditions, they are not gonna last. The ground is literally shifting beneath our feet as we speak.
This timeline just says it all.
We are right here in the 2024 buyer's market. But look ahead. 2026 is forecasted to be the pivot point, the moment when demand officially starts to outrun new supply. By 2027, the market is expected to be right back in the seller's hands.
So the analysis shows this clear, rapid shift happening in the market. All the leverage is moving from the buyer to the seller. The only question left is, where are you going to be standing when it does?